Hi, I'm Andre, and I'm going to chat for the next hour or so about investing for your retirement. So, why am I doing this? Well, I put together this talk over the last couple of years. Today is my last work day, my last week working, and it's great to be headed into retirement. And I guess I'm just passionate about financial literacy. So, because I gave this talk recently to some faculty and colleagues, and the feedback was good, I decided, you know what, let me go ahead and record this, and if I can share this with others and help them out, all the better. So why am I doing this? Well, when I started 20 years ago working here at my university, I knew nothing about investing, and I had saved nothing. And I was 41 years old, and, not a great place to be. This talk essentially encapsulates what I've learned over the last 2 decades and how the strategy I used to be able to retire at 61 after 20 years. Not too bad. I've designed this talk around what I wish I had heard when I started in this job. So hopefully I'm saving some people a little bit of work. I'm passionate about financial literacy because, you're doing your future self a favor, essentially, right? Most of us try to eat well and exercise to do our future bodies a favor. This is the exact same thing. And, I would make the case that evolutionarily we're very detached with our future selves. It seems so much in the distance, and we're just kind of wired to pay attention to things that are directly in front of us. And that's a problem. And you all know that in the back of your heads, and the earlier you can get started on this, the better. Now, so first, the title of my talk is actually a quote from Charlie Munger. He was the sidekick from Warren Buffett and kind of the brains behind Berkshire Hathaway. And it's a great quote, becoming a millionaire is simple but not easy. And you will find throughout this talk why I chose that particular title. Although I suppose another alternate title could just be Show Me the Money, right? Whether we like it or not, we live in a capitalistic world, and money is what we transact with. So unless you want to go live in a cave or something, I'm afraid these are life skills you kind of have to learn, because you need to. Now, I got lucky. When I started this job 20 years ago, my sister, shown here, went and bought me a subscription to Money Magazine. Now, don't go looking for it. It doesn't exist anymore, but it was kind of this magazine written at the 8th grade level about the basics of dealing with your money. And she started this kind of thinking in my head, and this education that I started becoming really interested in it. And mostly I became interested in investing so that I don't have to worry about money, not because I'm passionate about being rich. So, really the goal here in watching this YouTube video is to just that, you become engaged with your retirement planning, because if you don't, the repercussions are really not good. Now, when I look at my own journey financially, when I started here in 2005, I was making $50,000 a year. Now I'm retiring right around $100,000 a year. Counting this year's 2025 money I've made, I've made $1.4 million. And then when I look at my retirement investments, I'm currently sitting at $1.3 million. Now that's kind of cool, right? It's like as if I had saved most of my paychecks. So really, that's the context for what I'm going to be talking about today and how I kind of got there. So what I'm going to be covering with real quick, glance over what our relationship with in money, the retirement plan options that generally we have in academia, the major groups of investment options you have, phase salary again for those in academia, negotiating your salary, how much do you need to retire. I'm going to give a little plug for Fidelity's retirement planning tool because I think it is the best one out there. And what's love got to do with it? Well, you have to wait and see what that is. Now, if you're not in academia, don't worry. About 95% what I'm talking about here today does apply to you, and you will be able to benefit from it. So if I ask each person out there, how they think about money, I'm going to get many, many different answers. For me, money, is just a tool to get something done. I grew up in a middle-class family, and if I wanted money, I had to go out and work for it. So I always had, I think, a pretty decent work ethic. Now, just a few years ago, somebody at Sotheby's paid $6.2 million for this piece of art, banana on the wall. Okay, do they have a healthy relationship with money? No, I would make the case that they don't. So some of my favorite expressions are money doesn't equal happiness, but lack of money can lead to a lot of misery. I guess my favorite way of framing it is that money doesn't give you happiness, but it gives you options, okay? Once you have enough money to meet your basic needs, then kind of all the rest is kind of play money. But if you don't have enough to meet your basic needs and lead a comfortable life, that's not a good place to be. Mark Twain, for those of you who know a bit about his history, he had a really interesting relationship with money. He always wanted a lot of money. He was always chasing harebrained, get-rich-quick schemes, and we'll mention him again here in just a little bit. How much money is enough? I don't know. Okay, there's a bunch of studies, different studies out there. Study one shown here, was an often quoted one that said, hey, around $75,000, your happiness started to plateau out. Of course, that was, 15 years ago, so you'd have to adjust that for inflation. But a more recent study with a much larger sample size said, no, actually, your happiness does keep going up. Beyond that, again, for me, it's like, I just need enough to be comfortable, right? I don't feel the need to, look and be rich, right? For me, I'd rather just be rich as opposed to looking rich. Now, in the last 20 years, over the course of the time I've been working here, I've had some bad things happen, right? I've gotten divorced not once, but twice. And the S&P, the market, has incurred two significant downturns in 2008 and 2020. On the positive side, I started this job with no student loans. I got no kids. They're expensive little critters to raise, from what I understand. I think that's up to $30,000 a year right now to raise a child. I was willing to move. I'm dual citizen with Canada, so that was an option. I could just live and work in a lot of different places. I don't have to worry about supporting my elderly parents or leaving any money to them. And I do acknowledge some family privilege. The first house I bought in Rhode Island, my parents gave me $5,000 or $6,000 to help with the down payment, and I've mostly been a homeowner since then. Now, on the negative side about our job is we don't work at scale in academia, right? Meaning that if, I teach more and more students or they get better marks or whatever it is, my salary doesn't go up. Okay, it's not like selling cars. The more cars I sell, the higher commission I can make. And yes, generally I can earn more in the private sector, and getting a raise is a little bit more challenging. Okay, it's tougher to point to metrics to justify a raise. And again, we'll talk about that in just a little bit more later on in this talk. On the positive side, the fringes in academia can be pretty good. The investment options that you have in the accounts, there are some that are available only to people in academia. Here, at my institution, Fidelity is a good company. I like Vanguard a lot too. So those were the upsides. Now, a lot of people, are unsure whether they really want to go to the effort of learning how to manage all the investments themselves. Now, if you, after this talk, if you decide, hey, I really don't want to have to do this myself, fine. Go ahead and seek a fiduciary to help you Fidelity, if that's your plan manager at your institution, they give free consults. Hopefully, whoever manages your plan, you can at least get free consults with them. However, I would never pay anybody a fixed fee annual percentage to manage my investments. I have a friend, let's call him George. He lives on the East Coast. He's got over $1 million. He's just retiring now. And he's decided to do this. And I said, you know what? Let me run some numbers and show you what that looks like. So that's what I did. I went and ran these numbers. And, by him, it assumes, a good market run, 10% every year, 3% annual inflation, and that he's withdrawing $50,000 per year indexed to inflation. So as inflation goes up, he'll be taking out a little bit more. So at the end of the plan, so this was last year, so it's like, 25 years worth, he would have $3.6 million. However, if he's paying an advisor 1.7 at the end of the plan, he would end up with 1.6. So $2 million has evaporated. So how is it that's that number is so large? Well, it's because when he's paying that $17,000 per year, he's also missing out on the money that $17,000 would have made over those many years. So I am really not a fan of having somebody else manage my investments, and there's more context to this that we're going to be getting into. Let's be sure that we're not conflating investing with savings. Okay, if you just put your money under a mattress, it keeps losing its value by whatever the rate of inflation is. And if you put it in a savings account that matches the rate of inflation, you're only treading water. You're only kind of staying at the same level. So rather, investing involves buying and holding something of value, right? So generally, retirement accounts use stocks, right, or offer you funds. Bonds, real estate, precious metals, these are also can be part of a portfolio for investing. I would not put in, Beanie Babies or, vintage guitars. I'd like to make the case of vintage guitars, but they're certainly high risk. So why is it that retirement plans are generally around equities and stocks? Well, it's because long-term wise, there's just no safer bet than the stock market. Okay, since 1957, it's averaged 10% returns. Okay, now adjusted for inflation over that time, that number does come down to 6.6. Now, in the last 20 years, the period of time that I'm going to be talking about here today, it's averaged 8.4 annually over that period of time. So one of the core concepts to really understand about why investing works is this idea of compound interest, okay? So let's think of this simply. If I had $10 in a stock and it went up 10%, I would have $11 at the end of that year. Now let's pretend that second year, it also goes up 10%. Well, I don't just make $1, right? I make $1.10 because now I'm making interest on that $11, which is more than the $10. So that keeps building up each year, and that's the basic math behind compound interest. That's why when we look at these numbers kind of right here, okay, if we're saving over a long period of time, you have to save a lot less, right? $215 over 40 years gets me to $1 million, if, assuming a 9% rate in the market. Whereas if I'm only down to 20 years, like me, right, who got caught and was starting late, now you need to put away $1,500 a month. So that's kind of the challenge, right? And so getting back to the title of my talk, right? Why is being a millionaire not easy? Well, it's because you've got to kind of come up with this money early on. So that's one of one of the most basic and important philosophies in investing is that the longer you are in the market, the better. You can't really time the market. It's extremely hard to predict what the market is going to do, okay? And nobody really can do it. This is just a chart kind of showing you how many more up years you have than down years. And again, this was pretty much over the period of time that I was kind of, working. And when I look at my own investments, sorry, but it was only in 2018 when I started adding up and paying attention to how much I had at the end of each year. You can see how I only had a quarter of $1,000,000 7 years ago out of my 20, and now I'm up to 1.3. So, it's really towards the end when you start getting a big nest egg that things, it can really kind of accelerate into larger numbers. One of Charlie Munger's philosophies, to paraphrase him, was kind of like work really, really hard to get that first $100,000 saved, and after that you can take your foot off the accelerator. And again, that was, that goes along with the math that just if you can get a sizable little portion early on, then it gets an opportunity to grow. Now the problem with compound interest is that it has an evil twin, and it's called inflation, okay? Because just like your investments can compound, so can inflation. And again, if I look over the last 20 years, okay, inflation has increased, 70% since 2005 that I've been working here. It's like, that's a lot of, but here's the thing, right? During that same time, the market's gone up more than 400%. So I like the expression that what you're really trying to do, you can't control inflation, but you can outrun it. And I always thought that was a good way to visualize it. Okay, so in my retirement plan, and yours as well, right, there's three main areas you can invest in: the U.S. stock market, the international stock market, and bonds. Now, to slice that a little bit more, within the U.S. market, there's three main areas you can consider, okay? Large capitalization companies, so just big companies, mid-sized companies, and small cap companies. Now, there is also real estate. You can buy funds that are invested in real estate. If you've got a house and you're paying a mortgage, maybe that's enough exposure to real estate. That's how I played that. But there's nothing wrong with having a certain percentage of your portfolio exposed to real estate. So I said I was going to get back to Mark Twain. So this is a picture of me just last month with James Page's compositor, which was used in printing. Okay, so Mark Twain invested $200,000 in that machine, which is the equivalent of $8 million today. Okay, 2 were built, and they never sold a single one. So the lesson here is don't put all your eggs in one basket, right? You want diversification, and I'm sure every one of you have already heard of that term, diversification, that you don't, you want to be spread out. So when different parts of the market tank, your whole portfolio doesn't tank with it. And we will explain that a little bit more. So certainly one of the places people feel challenged when they're starting to learn about investing is, hey, what stocks do I invest in? Now, what's the difference between a stock and a fund, right? So a fund is just a basket of stocks. So as soon as you buy a fund, you instantly have some level of diversification. But as I mentioned, it is extremely hard, if not impossible, to predict what the market is going to do, right? And to prove that, there's this famous Warren Buffett story where he said, hey, you know what? I will give $1 million to somebody who can outperform the S&P market over a 10-year period. So Tom Sadie's decided, hey, I'm going to do that. It's I'll become famous when I do it, but he wasn't able to do it, and he conceded the bet even before, the decade was up. So the lesson here for us average people, right, is that low-cost index funds are just your best long-term option. So what is an index fund? Well, John Bogle is the founder of Vanguard and its original CEO, and he said, you know what, the path to financial independence is just an index fund that replicates the performance of a specific market, such as the S&P 500. And we will be talking a little bit about markets. So essentially it's like, you know what, and the S&P has 500 different companies in it. So you get instant diversification if you go to an index fund. Now I do want to mention really quickly here the difference between mutual funds and ETFs, or exchange traded funds. ETFs trade just like stocks, meaning instantly, whereas mutual funds settle at the end of the day. ETFs don't incur some trading fees that mutual funds will. Okay, so if sometimes if you buy Fidelity funds inside of a Vanguard account, they will charge you a fee. Whereas if you're buying it, Vanguard ETF inside of a Fidelity account, they won't. Sometimes ETFs also have lower fees, and the VTI is an ETF that's identical to the VTSAX, but the fees are slightly different. It's like, hey, the lower the fees, the better, right? So that's something else to pay attention to. Now, within your retirement accounts, if you're adding, if your paycheck is buying a little, some funds, they're going to limit you to mutual funds. You cannot probably in your retirement account buy ETFs unless it's in a Roth or something like that. They probably limit you only to mutual funds, so don't be surprised by that. I put this fund in here just as a reminder to talk about actively managed funds. So about 10, 12 years ago, I went and looked at what was the most invested fund here at my large university, and it was Prime Cap. And it's like, oh, and I looked at the performance of it, and yeah, that looked pretty good, so I bought some of it. And you can see how it's done over time, right? It just hasn't done nearly as well over time just compared to the overall S&P market. So you can be in academia and not be, all that financially literate, okay? And the reason why is that, actively traded funds are where the fund manager is trying to get the best performance that they think they can, right? They're trying to beat the market. And like I said, and like I showed, it's really, really hard to do that. And this is just kind of an example, a further example of it. So I mentioned the S&P, and you can see here's a nice little definition. It just tracks the stock performance of 500 leading companies in the U.S. Okay, it's kind of the go-to index, right? And you listen to public radio, you'll hear them always talk about the S&P 500. Now the Dow Jones is another index you at least know about. It tracks the leading 10 leading companies, so I tend to think of those as large cap, big companies. Okay. The NASDAQ is a tech-heavy index composite, so that's how I think of the NASDAQ. The Russell 2000 focuses on small-cap stocks, and lastly, I call it the CRISPR, but I'm not sure if that's right, CRSP. It's the overall market, so large, mid-cap, and so forth. Myself, I mostly care about the S&P 500 because the stocks that are in the NASDAQ and Dow Jones are inside the S&P 500, just in a different percentage. So it gives me plenty of exposure. I do provide a link at the bottom of this slide for those of you who want to go look at indexes for international markets. Additional proof that it's hard to predict the market. This is the last 5 years. You can see how the S&P, the Russell, the NASDAQ, they cross many times, right? So again, diversification over all of these areas is certainly sufficient. So here at my university, I had it pretty good. In my 401A, which is the same as a 401K, they just give it a different letter there because it's a nonprofit. I contributed 2.5%, and the university kicked in 13%. That's not the case anymore. About 13 years ago, they changed that to where employees are contributing 5%, and the university is matching 10%. But I would say the most important thing I would say is that 15% is a really nice number. I really, really like it. If you can put away 15% of your salary over a few decades, I think it's a real something to aspire to. Now, the sweet part of academia is that there are a couple of other options that I have, and maybe you have too, and that's an optional retirement account and a deferred compensation account, 403B and 457, okay? So the limits of those are over 23,000, and if you're over 50, they're even higher. Now, if you're like me, you're thinking, my God, how do people come up with money to contribute these, right? I'm already maxing out. I'm getting my contribution in my 401A. It's like I can't come up with any more money to put in there. Well, there's a couple of things. One is that if you have a partner and they don't have a very good retirement account or no retirement account, then you can say, hey, you know what? Let's say you pay more of the mortgage or the rent or the bills, and I will invest a percentage, right, for you in one of these accounts, a 403B or 457, right? If you're working well as a couple, then, negotiate that. Because again, the more you can take advantage of a tax-deferred account like these two, the better. The other thing to consider is taxes, okay? Because just as I'm ready to leave here, currently I'm just kicking in another $525. But I'm only seeing $375 less on my paycheck because of I'm paying less taxes. So it's not as much of a hit as you think it's going to be when you elect to save a little bit more in one of those accounts. You might have a Roth option for your 403B and your 457, so check into that. Roth accounts, whether it's a standalone Roth that you're doing or within your work plan, Roth accounts accept contributions that are post-tax. So you've already paid taxes on them, but they grow tax-free, meaning that when you go take out that money years down the road, it all comes out tax-free. That is a really, really sweet deal and really nice to take advantage of it. For this to work out well, you kind of want to open a Roth as early as you can, right? Because the more it builds, the stronger it's going to help, the better it's going to help you out. You can open your own Roth IRA within work or separately. Since our plan manager here is with Fidelity, I decided, there's no real advantage since it's post-tax. So I opened it with Vanguard just so I have access to Vanguard's, planning tools and some of their funds. And, I just didn't see much of an advantage to it. Currently, in 2025, allows you can contribute up to $7,000 per individual under 50, and $8,000 if you're older than that. Now, here at my university, if you're employed and they start you on a plan, there's default funds that are going to throw you in. And a lot of institutions are doing the exact same thing. They just put you in a target-based fund based on what year you're going to turn 65. They put you in a plan that will automatically allocate between stocks and international and bonds and slowly change as and becoming more conservative as you're nearing the age of 65. I'm not a fan of these funds. I used to kind of like them. I think they're good. I think it's smart that they're doing this for people who just never pay attention and never choose anything. This is not a bad option. It's just for me, who gets a little bit more involved and willing to take a little time to learn this stuff, there's better options. Here, there are also a bunch of core funds that I can pick from, but I'm really not too much of a fan of most of these, although some of these really aren't too bad. Some of the Vanguard funds, I remember looking at them and they weren't bad, but they just weren't among the best. What's nice here though is that there are options for you to go ahead and create a brokerage link account in Fidelity, and that gives you the option of investing in any fund that Fidelity will, it traffics in, which is pretty much all of them. And I know it can be daunting, right? There's more than 1,000 funds that are traded here in the U.S. on the New York Stock Exchange, but there's very few that you actually have to be aware of, and we will get to that. So now we get to some of my recommendations. Part of the reason I created this talk was because when you go to when you listen to a talk when you start your job from HR or the plan manager, there are always these very high altitude talks that talk about diversification. Here are your options. Talk about you figuring out your tolerance for risk. But then they leave you on your own and you still have to kind of figure it out. Well, I am going to give you an opinion here, but it's up to you to kind of do your due diligence, right? Don't trust anybody. I like to say I'm a skeptic in life, but I'm a cynic when it comes to money, because everybody seems to be trying to position themselves between you and your money. So, given that, I think here are some core funds that I think can at least start you off and allow you to compare other funds too. And at the very end of this talk, I will show you how you can kind of compare performance of funds to make your choices. So here I have index funds that replicate the S&P 500. You want to find some that have the lowest fees possible, right? So you can see these are all extremely low, 0.03, 04, 01, very, very low. And the turnover rate is a rate at which they are buying and selling stocks within that fund. Okay, the lower, again, the better, because when they're trading, they're incurring fees and you're the one who ends up paying those fees, right? So these are all good. I consider all of these good funds that have billions of dollars in them, that do a good job of replicating the S&P. If you want to buy something that's just replicating the total U.S. market, here's a few choices that you might consider. The one at the bottom is really kind of interesting. Fidelity does have some zero funds that actually have, zero fees to them. It's kind of like a lost leader for them, where they're trying to recruit people who will hopefully buy other funds that they can make money off of. Technically, it doesn't, they make their own index for these to follow so that they're not paying fees to the S&P 500 and such. But they mimic the same group of funds, so, I put it in the same basket. Some international funds. Now, you can buy funds that for specific countries if you want, but if you just kind of want some international exposure, I think these are two fine funds. Generally, international funds will have higher fees. That's just kind of how it goes. Lastly, bonds. So bonds are not equities. They're not stocks. Rather, they are promise notes when people borrow money. Essentially, companies borrow money, government borrows money. There's a variety of funds. I actually find bonds the most complicated investment to understand. So given that, there are here are a few options. I do like TIPS or Treasury insured bonds, so that you're kind of splitting things up. That when inflation goes up, inflation protected securities will go up. VGBX, the Emerging Market Bond Fund, is a nicely performing fund, has a very good Morningstar rating, but it is a little bit higher risk, right, because it's so much in international, emerging markets, rather. BND is one of the premier bond funds, very broad, a lot of people hold that one. Lastly, to touch on ethics, I think this is a challenging one, right? If you don't want to invest in companies that, create machines used in war, or petroleum companies, if you want to invest in companies, green companies and such, then you can seek those out. I think it's great if you can do it. Sometimes the performance of them are not quite as good, and that's fine if you've got a long time horizon. But I think it's certainly something for you to consider, right? Are you putting your money where your heart is, and not to, but not to the extent where you're really gonna do poorly in the market. So now we get to the big question: is how much do you allocate to the different groups, right? Small cap, large cap, international, and bonds. So my percentages here, these are my own. I think I'm within 5 or 10% of what everybody else kind of recommends. If you're in your 20s, hey, you're a long ways away from retirement. You don't even have to put anything in bonds, okay? So I would say a 70-30 is pretty reasonable. If you're in your 40s, now, maybe 10% in bonds is reasonable, and U.S. and international is adjusted a little bit. If you're in your 50s, maybe up to 20% in bonds. And then it changes as you get older. So you can just see how essentially you're moving towards more bonds as you retire. And most people, when they retire, 60-40 is the sweet spot, where people will keep 60% in equities and 40% in bonds. So if you are watching this, or if I was watching this, one thing I'd want to go, well, what are you actually invested in? So if you want to stop this, freeze this presentation and look at what I'm currently invested in, by all means go ahead. I don't recommend this because this is specific for me and what I have going on, with me and my partner. Okay, and some of these things have actually changed. I will point out two things in this slide, though, however, and that's it. One is cash, right? So I've got, about $50,000 in cash, and that's emergency money, right? If my car dies, if my partner leaves me for her tennis instructor, or Pedro the pool boy, it's like, hey, these things happen in life, right? So at least it's going to reduce the stress, right, if something like that happens. Also, you can see that I've got, like currently, I have three individual stocks in my Roth IRA. That's my play money. It only adds up to 3% of my portfolio. It's my fun stuff of trying to keep engaged with the market. I've actually sold Amgen. It did not do well this last year, and I bought FIX. If you want to look that one up, we'll see if it does well or not. But I will also point out that within my Roth, I don't have any bonds, okay? Because as we talked about, Roths build tax-free, right? When I withdraw that stuff, it's tax-free. So it's where it pays the most to take the most risk. So I don't recommend any bonds in your Roth. Now, let's talk a little bit about getting a raise. So, this is my current compensation as I'm getting ready to leave here. And it would be wrong if I just looked at the salary, right? Instead, I've got to look at all the money that's being paid by my employer. And you can see it adds up to a substantial amount, right? So I go from 98 to 130,000. So I'm just saying, hey, if you decide you're not happy in your job, make sure you're looking at the total compensation, okay, and not just, your salary. Because again, perks in academia can be pretty nice. You also want to consider inflation in your calculations, okay? So when I started here, right, as I mentioned, I was making $50,000 a year. But now that has the same buying power as $82,000 today. So that really means my salary has only increased $17,000 over 20 years. Not so good, right? So it's like if I was staying here longer, I might consider going to my supervisor and showing these numbers as justification why I deserve a raise. So what my story was in academia, and unfortunately it seems that generally, here where I am, the best way to get a raise is by getting an offer elsewhere. So that's kind of what I did. I started interviewing for a higher levels positions back in 2013, and I did get an offer, in six-figure offer in Canada, but for various reasons I didn't take it, but I was able to leverage that into an offer so that, my salary increased to $11,000. Now you can just go ahead and ask, but it's nice to bring in supportive data like, this is the average salary for somebody doing my work elsewhere in the U.S., and I'm being paid under that, right? But I would also say, be critical on yourself, right? Are you really God's gift to academia and teaching, or are you pretty much average? And it's like, it's doing a little kind of self-reflection, giving yourself the tough love. It does help too, right, to be politically savvy and make sure that the people who might be in a position to help you get that raise are informed of this, right, and that they can do their own networking and talk to deans, department heads, whomever, to try to have your back in these negotiations. And lastly, sometimes you just need to leave, right? Maybe you outgrow your position or the institution you're at, and that's just kind of how it goes. Again, for me, it was always easy. I was always willing to leave, so I had that option. So, how much do you need to retire, right? When I was showing my numbers and saying I was at 1.3 million, well, is that enough to retire, right? That's really the question. So, here's the thing. It's not the question. The real question is what salary do you wish to retire at, right? A lot of us could retire if we're only living on, $1,000 a month, right? But that's kind of pretty hard to do. So the way to get to that number is just, hey, figure out what you're spending all your money on, right? So these are just some made-up numbers, right? Your utilities, your health insurance, your rent, your mortgage, whatever. And so, if you figure that out. So for my own calculations, I said, let's assume that I need $5,000 dollars a month, me and my partner, to pay all the bills, okay? But I want some play money. I want to be able to travel, go hunting and fishing, buy another guitar here or there or something, right? And that would add up to $3,300. So essentially, I want to say, hey, you know what? $100,000 a year, I could be comfortable and I would be happy with. So once I have that numbers, in Fidelity, there is this really nice tool, a retirement planning tool. And it's the best one that I've kind of seen out there so far. I do list a bunch of other planning tools in my resources at the end. So it all depends on what you have access to. But in this particular tool, what's really nice is I can go in there and I can put in all these numbers. And on the left-hand side, you can see there's a little edit. And if I hit that edit, I can go ahead and I can put in what do I own and how many, stocks do I have. And it can go ahead and it will keep, of course, Fidelity knows everything you have in Fidelity, but if you have outside accounts, you can go ahead and add them in there. And then at the end, it will create this really nice chart for me, my asset projection. Okay, so in this case, it gives you 3 lines essentially. The top one is for an average market, okay, we will both die, my partner and I, and we'll have over $5 million in the bank for an average market. Now, if it's significantly below market, it doesn't run down to 0. If I use that pull down menu and go to the yearly cash flow, then I get this nice little chart here. Where's the money kind of coming from? And I can click on each one of those bars and see some numbers, and it's really kind of nice. The little triangles at the bottom are the dates we expect to expire or have our groundhogs deliver our mail, as I like to say. And I find great humor in that, figuring out when I'm going to croak. I'm guessing 2049, but I usually round it to a 2050 because it's an easier number to remember. So a lot of us here have heard about the 4 to 5% rule where, they say, well, if you have $1 million, you can take out $40,000 or $50,000 per year indexed to inflation. So as inflation goes up, you take out a little bit more each time. What I would say to that is that, yeah, I think that's a good benchmark. But if you can adjust your spending each year depending on how the market does, then, it's okay if you're spending a little bit more than that. As I showed, right, I have $5,000 to meet my essential expenses, and then $3,300 for my play money. Okay, so if the market does really well the previous year, I could be pulling out, more. But if the market's really tanking, hey, that $3,300, let's not, spend that much or any of it. Let's just, tread water to allow our money to recuperate. Now, I probably don't have to do that because there's enough, but if I'm forced to retire and I don't have as much, and if those projection lines go into the 0 in a bad market, then again, if I can adjust my spending, if all the money I'm taking out is not for essential expenses, then I have some flexibility. Now, these are 2 other expressions. They're not mine, but I always thought they're really good to kind of keep in the back of your head. And that's that what happens in the market 5 years before you retire very much determines how much you actually have in retirement. So if you remember that chart I showed how much my investments grew between 2018 and the end, that kind of, is reflected in that. The other thing is what happens in the market 5 years after you retire determines how much you can spend annually, right? So if the market does great in the next 5 years, right, I'll be 66 by then, and, it'll be hard to spend all my money down before I croak. kind of thing. So you're kind of at the mercy of the markets, right, for a 10-year period of time, and that's disconcerting to a certain extent. And all I would say is, look, you can't predict, but you can plan, right? So to a large degree, I'm just planning for worst case scenarios here and hedging my bets and following the math of investing. Now, another one of my favorite expressions is, smart people learn from their mistakes, but real smart people learn from other people's mistakes. So one mistake I did not do was go up for full promotion. I should have. I just got lazy, and I didn't think I was going to last here that long, honestly. So it's like, don't be like me. As soon as your portfolio is significant enough to go for a promotion, go ahead and do that. We talked about actively managed funds and the prime cap funds. Don't do those. You might consider, we all like to have that emergency fund, and a lot of people do it. Maintain one, but be aware that you can take out money you put in your Roth without any fees. You can't take out the interest, before you are 59 and a half, but for an emergency, if you need to keep, $30,000, and you've contributed $10,000 in your Roth, you might consider those $10,000 as for emergencies, should that happen. Be aware that at 59 and a half, you can move money out of your accounts if you have a crappy plan manager and not so good investments. You can take it all out, move it to Vanguard or Fidelity to have better investment options for yourself. Real estate is a sweet spot. I wish when I had moved here, I'd bought a duplex and rent out the other half and then buy a house and, just build some equity in real estate. Not everybody wants to be a landlord, and I totally get that. But, I didn't think I was going to last 20 years here either. So, again, it's not for everybody. Lastly, just be aware if the market really does tank, you can sell your investments at the end of the year, recoup up to $3,000 in losses, and then buy them again more than a month later. If you look that up, you can learn the details. I didn't do it in 2008, but I did do it during COVID and got a little money back. You might consider creating yourself like a Google sheet or some spreadsheet of your investments just to track how everything's doing. In this example here, right, I have monthly columns. Don't go in there every month and check how your investments are doing. Just go in, twice a year or once a year when you're young. And as you're getting older, start tracking them a little bit more closely. But don't obsess over the market. It's not healthy to do that. You can very much, like the Ronco chicken rotisserie, right? Set it and forget it. Once you figure out your investments and your allocation, it's pretty much, you can just leave it and let it keep going, minus the rebalancing you need to do at the end of each year. If you decided you're going to do 7, 20, and 10 during that past year, some investments have done better than others, and now you're not at 70, 20, 10. So you just want to go and sell and buy and readjust it to that same percentage. That's all. But just track your investments so you can see what's working well for you. Now, I'm 61, I'm retiring at 61, so why am I a big believer in retiring early? Well, you never know how much time you have on this planet, right? And I have colleagues younger than me who have passed away. You just don't know how much time you have, and there's other things I want to do in life. And again, this is why I'm so passionate about investing and planning, is because it gives you options. And for me, I have other things I'd like to do. The other thing is that your health is going to decrease. I've always been so healthy all my life, and then after 50, things start changing. And then after 60, other things change. So, be aware that your full health average for men is under 65, and for women it's under 68. So think hard about projecting the things you want to do and when you want to retire. Now, here at my institution, I have a phased retirement option, which was really, really nice. It was optional, though, if the department wanted to offer it to you or not. Essentially, it's an incentive to get people, with a continuous appointment or tenure to retire, right? Like, please leave. And the advantage is they give you $50,000 when you do finally leave towards health insurance. So that's what it is here. And they will pay out, your vacation up to a certain amount. You have to be at least 55 here to do it, and it can last 1 to 5 years. I did it over 1 year, and I went down to just 75% time. It was very sweet to have every Monday off and like one Friday a month off as well. It really, really was very, very nice. So hopefully you have that option as well, so you might consider it. All right, I mentioned about rebalancing your allocations at the end of the year. It's the only kind of housekeeping thing you really need to do. My advice is never buy an annuity. So an annuity is essentially for those of you who don't know, is an insurance type vehicle where you say, hey, I'm going to give you $100,000, and then when I retire for the rest of my life, you're going to give me $1,000 a month or whatever it is. So, it's like extended warranties. Okay, statistically, they're going to make money off of you. Okay, if you've started getting those free steak dinners for retirement talk in the mail, that's what they're trying to sell you. They're trying to sell you annuities. I think they're awful. I will never buy one myself. Yes, there's a place for them for people who are really fretting over how much money they can take out each month. But for your average person, I really don't recommend them. I used to have some target funds. You can do a lot worse than a target fund. A low index target fund is not so bad. But, they've gotten worse in terms of their fees and their performance, and myself, I just don't recommend them. Lastly, I want to make sure all of you go to the socialsecurity.gov website, create an account so you can track things and you can get some estimates too on what you can expect for Social Security payouts at 62, 65, 70. I meant to mention when we were looking at my projections in Fidelity, for me, I plan on taking it at 70 to get the maximum payout. Okay, to me, I think of Social Security as longevity insurance. If I die at 72, fine. But if I live to 95, I kind of want to be receiving that maximum amount. So that's how I think about it. So, one last piece of advice. What's love got to do with it, right? Well, invest in your relationships just like you invest in your retirement accounts, okay? It's one thing retiring with $1 million. It's very much different retiring with $500,000 when you lost half of it in a divorce, okay? Relationships are hard. I get it. But it can really make or break you in a lot of different ways. And it's hard having a healthy relationship with money and having a partner who has an equally healthy relationship with money, right? More things to negotiate. Again, I'm not a great guy to be offering relationship advice, I don't think. I've certainly learned a lot. And be aware, too, that the greatest predictor of divorce is not cheating or parental decisions, it's actually financial disagreements. Okay. Interestingly, people over 65 have the highest divorce rate of any age group. And who does worse? Women. Okay? Women generally see around a 40% decline in their standard of living compared to a 25% decline in standard of living of men. Okay? So yeah, I guess the only advice I would give you is I'm not really pro marriage, but if you're going to get married, fine, just get a prenup. That's all. Get a prenup so you know what to expect if you break up. When I was giving that example of, maybe you want to invest some of your partner's money for retirement in your accounts because they're more generous than theirs, we'll just have that in the prenup, right? If we break up, you're getting all that money back, right? Put it in writing so that everybody knows what to expect. All right, lastly, here's some resources. The last resource on the YouTube line about psychology of money in 10 minutes, wonderful, wonderful video. I suggest you read it. I hope the John Oliver video is a fun one too. At the bottom, the free simulators, a lot of fun to go and put your numbers in and see what it projects for different portfolios. It's similar to the Fidelity tool, but a little less granular. Lastly, a few web resources. iBonds are a nice place to stick money for a rainy day, for your emergency money. If you want to go live in another country, the last one's just kind of fun to kind of look at. I will mention that be careful that some countries see your retirement accounts in different ways. For example, if you go to Australia, they won't recognize a Roth account. They will tax you on your Roth withdrawals. Okay, it's like, oh, that was interesting to discover. So yeah, do your homework before you seriously consider another country. Just a couple of books. Estate planning, especially if you have kids, you're going to want to think about trusts. I don't have kids, my life's easy there. The Scott Galloway book is a good one. I think it's also a great gift to somebody, a senior in high school starting to consider what do they want to major in and have a career in. He's got some really good career advice. And there's also just good stuff about investing that I think you'll like. Okay, I will end with this cute cartoon from Calvin, but just before I leave you, I will go and, because I mentioned how are we going to about comparing stocks and funds and such, right? So I'm going to use Google in this example. Go ahead and look up stock comparison tool. And there's a bunch out there and they're fun to look at. I'm just going to, since we're so Google centric here in the US, I figured I would just use Google Finance as an example. So if I scroll up here, when you log in, you can see this is what the market's doing, right? So we talk so much about the Dow Jones, the NASDAQ, the S&P 500. So if I click on there, okay, I can click on like 5 years, right? I can see what's happened. It's gone up 100% in the last 5 years, okay? So you remember how I showed you a list of some of the index funds that replicate this index, okay? What was interesting about those charts is I didn't show performance, did I? Because performance for an index fund just means it is doing a really good job of mimicking the specific financial index for a low fee, right? And we talked about fees there. So you can see towards the bottom here, there's a compare to, right? So I can click on that and I can put in something like, let's say put it in VOO, okay? Because I did that, okay? And you can see it's not even, you can't even see it. It's right there. If I go to a smaller, I still can't see it. Oop, hang on. Oh, there we go. It was just a little slow with the Wi-Fi. So you can see how it's just doing a really, really good job. Now, VOO is an ETF. Okay, it is not a fund. So that might not be such a great example, right? So let me go ahead and put in a mutual fund that I also had on that list, VFIAX, okay, the Vanguard 500 Index Fund, Admiral shares. So you can see it there. It's doing a good job over 1 month. If I click on that 1 year, I can see it's still doing a great job. I can go to 5 years. Again, so that's all I want, right? Whatever can mimic, and I can see the numbers at the bottom, right? 100% for the S&P, and it actually outperformed it by a hair, 100.46%. So that's how I compare funds. So if somebody suggests a fund to you, you've got funds in your plan that I didn't list, hey, go ahead and put them in here and see how it compares to the index it's mimicking. So that's everything I had to say. I hope you have found this valuable. And put a comment below if there's anything I can help answer. Bye.